In a survey conducted by the Wall Street Journal in early 2024, the topic of a recession in the US economy was still being discussed. Experts estimated the likelihood of a recession within the next 12 months at around 39% compared to 61% a year earlier. It will be interesting to see if any of the more than 70 experts mention the possibility of a US recession in the update forecast for 2025. Judging by current macroeconomic data, there are signs of an economic downturn in the US right now. However, something reminds investors of the start of 2024. Back then, if we will call inflation was the main concern. Later, toward the end of the year, investors shifted their focus to the weakness of the US labor market. But now, as was the case of a year ago, traders are once again trying to predict the trajectory of inflation, including the impact of tariff hikes in the US. Donald Trump's future policies are a key factor in these forecasts. Analysts expect his policies to spur economic growth and speed up inflation. The article published by the Washington Post on January 6 about tariffs was a vivid illustration of this. However, at that time, the incoming US president quickly dismissed the report. Now, Bloomberg, citing informed sources, has revisited the same topic. The periodical reports that Trump's team is preparing a schedule for the gradual increase of trade tariffs. The proposed tariffs would rise by approximately 2 and 5% monthly. This approach aims to avoid a sharp inflation spike while leaving room for negotiations. If inflation does not accelerate, the Fed Reserve might revert to rate cuts. However, this is a long-term scenario and not necessarily a guaranteed outcome. As a result, today the dollar's 6 currency index is trading firmly in the green zone, near its highest level in over 2 years. Incidentally, experts at Goldman Sachs predict that the index could rise by another 5% in 2025. At the same time, Goldman Sachs analysts reckon that the euro will drop below parity with the US dollar to 0.9700 within 6 months. Experts at the Deutsche Bank agree, forecasting that the euro-dollar pair will fluctuate within a range of 0.9500 to 1.0500 this year. The hallmark of the year will likely be sharp spikes and drops in the instrument's exchange rate. And this was evident in the pair's reaction to insider reports from the Washington Post and Bloomberg, and similar reactions are expected in the future. On a Tuesday, the euro broke its 5-day losing streak and entered consolidation within the range of 1.0242 to 1.0279. The nearest technical support and resistance levels have shifted to 1.0155 and 1.0305 respectively. The bullish scenario would be invalidated by a break below the critical round level of 1.0200 and a move toward the technical level of 1.0045. All eyes now turn to the key US inflation report set to be released this week. This data could further influence expectations of a Fed's policy moves and forex trends. For instance, if consumer prices accelerate from a 2.7% to 2.9% on a year, the dollar is likely to gain strength. For more details on this and other economic data, as well as the potential market impact, check out our traders calendar. Crude oil is trading higher. Crude benchmarks surged sharply following Friday's news that the United States imposed new sanctions on Russia's oil industry. The sanctions specifically targeted companies such as Gazprom Neft and Surgutneftgaz, as well as over 180 tankers. As a result, Brent crude ended the past week with a gain of 4.3%. However, the full impact of these restrictions is difficult to estimate at this stage. Amid this uncertainty, oil prices are likely to remain on a bullish trajectory. Moreover, other factors are also contributing to the rally in oil prices. Chief among these is demand from the US economy, whose resilience was underscored by the December non-farm payrolls report. Additionally, mounting concerns among traders about the potential imposition of US tariffs on oil imports from Canada are increasingly becoming a driver for the oil rally. In the current situation, the ruble has come under the influence of two opposing trends. The introduction of new Western sanctions has exerted moderate pressure on the Russian currency. The market is pricing in the likelihood of additional restrictions ahead of time. The odds are that the already imposed sanctions could further dent exports volumes, escalating pressure on the ruble by the end of the second quarter. Meanwhile, in the near term, rising oil prices have provided support to the Russian ruble, keeping the dollar-ruble pair trading within the range of 102.10 to 103.40. The news of preparations for a meeting between the presidents of Russia and the United States may have contributed to the ruble's strengthening. How is trading going to unfold in the short term? We will definitely tell you in our next video reviews. Don't miss them and stay up to date with the latest news with us. See you soon!